And turning back to markets, it's been a wild ride in the first 2 days of the year. Some of the top performers of 2015 started out the new year as some of the biggest losers, maybe giving us a little hope. As we kick off this year, the top name being Netflix. The streaming giant posted a gain of more than 134% last year, but ended yesterday's session down more than 3.5%. Amazon, also a big loser, falling more than 5.5% after ending last year, up more than 117%. And it's a name everyone recognizes. Starbucks falling nearly 3% yesterday after gaining 46% in 2015. So let's bring in an expert on this, Wells Fargo equity strategist Gina Martin-Adams. First of all, should we be fearful of what we've seen so far? I mean, we're just about to enter the second trading day of the year, but really, I mean, it was a big sell-off yesterday and spooked a few people.
Right. It was certainly a pretty ugly way to start the year. I mean, a couple of things happened yesterday, I think, that sort of all pounded down markets. One was obviously the geopolitical tensions in the Middle East, but also we got some pretty negative manufacturing news in China, which really kicked off a negative trend for the day. That was followed up by negative manufacturing news in the U.S. So we did a lot of analysis on manufacturing sector, as it is still a pretty critical component of the economy. And when the economy turns over, then you do get fearful for stocks. And what we find, quite frankly, is the manufacturing sector goes into recession or compression quite a bit more frequently than the broad economy does. So we're not worried yet. When I will get worried is if the non-manufacturing sectors of the economy start to slump as well.
Because there are a lot of calls out there by some of the big banks that we could see a recession this year. Right. But speaking specifically about those stocks that we just mentioned, they were some of the biggest winners last year. They had big sell-offs to start off the year. Should people be looking at this market right now or some of those names and saying, hey, this is a buying opportunity?
Probably. I think so. We certainly believe that consumer discretionary and technology are some of the best areas for growth opportunities in the index. They're actually some of the highest quality segments of the index as well, and those characteristics tend to do well in an environment where earnings growth is fairly slim, but also the Fed is increasing interest rates, making the cost of debt a little bit more expensive.
Gina, what I find so interesting about the action the last couple of days is we had some bad news out of China on manufacturing, some troubling news about U.S. manufacturing, a lot of turmoil overseas. This all hurts the manufacturing sector, and yet the stocks that got hit the most, Netflix, Amazon, Starbucks, those are service and technology companies. So why are service and technology companies getting hit when people are worried about the manufacturing sector? How do you explain that disconnect?
Well, it's a little bit short-term disconnect, but most of it, I think, is just liquidation of last year's winners and a bit of portfolio rotation, which you tend to see a lot of in the December and January period. So you try not to draw too many conclusions on short-term trading.
Well, except that they're expensive, though. These are expensive stocks.
They are.
And you have to be very careful about overpaying for growth that might not materialize. And isn't that a bigger problem with the overall market? I think trailing 12-month PE was 23 times ending the year, which is well above the average.
Right. If you use the reported earnings estimate,
the reported earnings.
If you use on operating earnings, it's 17.5. It's been about 17.5 for the last year. We think fair value is close to 17, so it's not nearly as awful looking.
But it's still expensive.
What I'd say about valuation is at this stage of the cycle, valuation no longer rises, driving stock prices. It becomes all about growth, which is why those stocks worked last year. It's not because they're expensive and we're fearful of expensive and we think they're going to get more expensive. It's because they're actually producing growth.
But Gina, this doesn't look like a normal cycle. I don't see how you could say what multiple expansion is going to look like in this cycle when it's been so different than any cycle we've seen since the Great Depression. You know, usually in a normal cycle, the housing market booms early in an expansion. It hasn't done it this time. Usually you see fiscal policy expanding early in an expansion. It hasn't done it this time. So can we say anything about what's going to happen with multiples?
Well, it has been a really strange cycle in a lot of ways. So one thing is very consistent. When liquidity accelerates, multiples rise for the equity market. Liquidity accelerated over the last several years, multiples rose. It's no coincidence that when the Fed stopped expanding the balance sheet, multiples stopped rising on the equity market. Now that the Fed is actually starting to increase interest rates and tighten liquidity provision, we'll probably see multiples come back. That's normal. Believe it or not, that happens at the beginning of every cycle, and then as the Fed starts tightening policy, we start to see multiples compress, and we see earnings growth take over to drive stock prices.
We're going to have to leave it there, but big government jobs report on Friday. Any predictions?
You know, we think somewhere around 200,000 jobs is the average and probably will occur also for December. So no huge surprise out of the employment report. What I'm watching certainly is for manufacturing and oil and gas sensitive industries to spread, the weakness there to spread to other areas.
200,000 would be a really good number.
Yeah, absolutely. We'll take it.
All right, Gina Martin Adams, thanks for joining us this morning.
Thank you.